From the morning reading, the spider at resistance day 3. Sellers control open, buyers control close. 7 of 9 sectors moved higher on Wednesday. XLP, XLV, and XLU were the strongest sectors, while XLK was the weakest sector. Oil futures rose 8 cents to close at 48.91. Breadth strengthened as advancers led 2002 to 1021 on the New York Stock Exchange and led 1610 to 993 on the NASDAQ. Some bulls are coming back after seeing ample evidence of apathetic investors in recent surveys. Investors Intelligence noted this week that bulls rebounded by 10 percentage points, one of the largest one-week gains in more than 30 years. The jump was more than 2 standard deviations above average, which curiously has led to more positive returns than negative. The S&P 500 managed its third positive month in a row in May, coming on the heels of a 12-month low. The 3 consecutive down months, the momentum is impressive. It also tends to last with gains over the next several months most of the time. That's especially the case if stocks rise in June as well. Stocks have struggled after the June non-farm payroll report. The report due Friday has led to a negative return on the S&P 500 over the next 3 days during 13 of the past 19 years. The worst performers were healthcare, biotech, and semiconductors, while the best were commodity funds, including oil and gold. As short-term optimism jumps, it raises the risk even more of seeing some letdown following the report. Among the funds that followed, there isn't a lot of positive seasonality for June. The worst offenders were home builders, retail, and financials, all of which averaged their worst returns in June. As XHB and XRT optimism ticks towards extreme optimism, that seasonal headwind takes on even more ominous tone. The month also hasn't been that kind of grains like corn and wheat. At least oats have tended to do well, as has sugar, though the latter is suffering from already high optimism. From a seasonality standpoint, it's worth noting that at least for today, June the 2nd, there's a relatively high bullish bias for the S&P and the NASDAQ. So keep that in mind. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:53 a.m. Mountain Time, and I'm recording this in preparation for the market day of June the 2nd, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, after a full day at my new trading desk in the Rockies, I think I'm starting to get back into the swing of things and get settled. Let's go ahead and dive into the morning report. Slightly down on all 4 of the broad market indices that we follow, and really not a significant separation from scratch. Crude oil also just below scratch. Euro just above scratch. Bonds up about 10-30 seconds, or about 0.2%, and gold up about 0.25%. In overseas action, China up about 0.4%, Hong Kong up about 0.5%. Japan is the lone significant mover of all these future markets that we examine coming into our market day preparation. Japan's down over 2%. The German DAX is up just over scratch, and the United Kingdom is up about 0.5% at the time of this cut. In terms of macroeconomic reports for today in the United States, to note would be there's OPEC meetings, so that can always have an impact on markets, but the problem is there's no particular set time when that news might be anticipated. So you just have to be aware that OPEC is meeting. In terms of the United States, of note, we have the non-farm employment change from ADP. We have the weekly unemployment claims, FOMC member Powell speaking, nat gas storage, and then crude oil inventories on its special Thursday time slot following the holiday weekend. And looking forward to tomorrow, the big one, the monthly employment reports, and their various sub-reports come out. So keep that very much in mind. We'll likely go sideways and consolidate in front of that report, and then obviously respond to that report. Later in the day tomorrow, we have ISM non-manufacturing PMI. Also, factory orders and FOMC member Brainard speaking, heading towards the close on Friday. In terms of current volatility conditions, let's make that a little larger. There we go. That should be a little easier to see. Volatility has been decreasing. If you look at the 5-day versus the 10-day average, it is coming down slightly. Short-term VIX 11.61. Skew, though, has been climbing up and now went over the 130 threshold to 132. About a 10% probability of a 2 standard deviation move within the next 30 sessions. IV percentile for all 4 the broad market indices is very, very low. S&P at 11, the Russell at a 13, NASDAQ at an 8, and the Dow at a 6. Note that we now have 2 of the 4 here that are in single digits, so these are getting really, really low. From a volatility standpoint, especially during the summers, volatility can be low for pronounced amounts of time. It's just more kind of like what we talk about with sentiment when we get to the sentiment areas of the daily report. When these get extreme, we just look for signs of reversal, because obviously at some point volatility will expand. But that doesn't mean it expands today or tomorrow. It may take a while, but we watch for those signs and symptoms that show us that volatility is expanding. So anyhow, bottom line, very, very low IV right now. Probably not getting an awful lot of premium for selling premium strategies compared to perhaps more average times. No standard deviation moves were put in yesterday on a close-to-close basis by any of the 4 indices that we track. And you notice on the 2-week basis now, getting pretty light, only 2 standard deviation size moves in the last 10 trading sessions. Let's go ahead and go to the charts. And let's start with the S&Ps and the futures. And you see we're continuing to fight this area of overhead resistance. This has been kind of a monologue of a story, and it's still true, and until proven otherwise, it's going to be the story. But we've not done anything to break through that. We had a little bit of weakness yesterday. One of the morning authors mentioned that, where the morning belonged to the bears, but the afternoon and close belonged to the bulls. And most people consider the closing price to be the most important price of the day. And that close was a slight gain over the prior day. And while there was a bit of a tail here, ultimately the bulls did rule that day. Overall, that's a consolidation pattern. Really didn't prove to any significance anything on either side. So we'll have to wait to see if we are able to break into this resistance zone and start to make any kind of headway. Right now, it just doesn't seem to be the energy and momentum in the market to be able to do that. But we'll see. That's one theory. Second theory is that we continue in this sideways pattern. And third theory is that we have a total breakdown. Right now, there's probably a lot more support underneath us than there is energy to get through that support. So it would seem that current circumstances would lead to the theory that we're going to stay in a sideways pattern until something moves it out. That's a little bit of a difference. When we were back here, we were thinking that we might start to break down, especially when we were looking at the head and shoulders pattern back here, and we even probed one day, but then the bulls came roaring in and ran us for multiple days all the way to the top of this area against the resistance zone. Of course, they then fell off their energy. So they have enough energy to keep us from breaking down, the bulls do, but they also don't seem to have enough energy to actually achieve anything and get up through this area of resistance. So we continue to talk about that story, but that's where we are right now, and your trading strategies should be reflective of that. Let's take a look at the Dow, see if there's any significant differences at all. It's been a tight correlation with the S&P of late, and I don't really see any significant difference in that pattern today. NASDAQ, I think probably the only real question right now is, do we get a lower swing high from this pattern here? Obviously, we took out this swing high and had a higher high at the very least at this point. So in the short-term pattern, it's bullish. In the more intermediate pattern, I would say that this is now in a sideways range with similar highs and similar lows. And probably could make something of an argument. Well, we'll see here. On the Russell, this is probably, what we had a short-term pattern that was kind of bearish. The bulls came in, rescued it, and then now have established a higher swing high. So on the Russell, things seem to be at a relatively stronger position. So we'll see if that can continue. It's probably up right on its resistance zone from this swing high. If it breaks through that area, it does have some room to run up to about 1,200 on the Russell futures. Let's go ahead and take a look at bonds, see if they're giving us any insight. Not terribly. It's had a bit of a move the last couple days, but it's right up against the resistance areas. And until it breaks those resistance areas, I wouldn't make too much of that movement. And then gold's been bouncing a little bit, but has been decidedly weak in the last several trading weeks. And then VIX, volatility's been very low. We talked about that in our market condition report. So basically in a sideways, similar highs, similar lows. Not anything really to make of this until it breaks out of that pattern. So that's been kind of the mantra today of waiting for something to develop in a break of a pattern, either up or down on these various correlated and largely correlated markets. Until that happens, we're not likely to be able to get any kind of trend move or any kind of significant action that follows through to anything, and that should be very much on your mind as you initiate new trades. Let's go ahead and take a look at that, and there we go. Well, it's sized a little better. In terms of initiation of trades, well, we do have permission to initiate new short-term and intermediate-term trades from the mechanical signals. Indeed, the market trend intermediate term phase opinion is in phase 2. That's bullish. It's trend reversal. That's a positive sign. From our 3 market timing signals, from IBD, we have confirmed uptrend. From GMI Index, we have a perfect 6 out of 6 with the buy signal in place since 525. From Stock Charts Decision Point scoreboard status, we have the improving conditions and basically short to intermediate term almost universal bullish signals with only one lone signal in the bear camp. The long term is very, very mixed, and we're waiting to see if that can start to change, and obviously that will not likely change unless we break this pattern and start establishing new all-time highs. If that happens, we will have a stack, and that would kind of complete the picture in terms of mechanical signals of giving us an all-forward, all-go bull pattern. In terms of position sizing opinion, as you would expect from the above, 100% on both models. Intermediate term market posture, severely strong bull. Wow, what a change from just literally a few sessions ago. Those bulls, when they got to the threat of a head and shoulders pattern breaking, they really stepped in and they ripped this action back to the other side, And we now have the S&P up over 80, the NASDAQ and the Russell, all three of those up over 80. Only the Dow is relatively weaker at about a 60, though that's in the strong bull camp by its own measure. This is up against the face of a weak bear sentiment line. That's a longer term, less sensitive indicator. So normally with a bearish sentiment line, we would expect that the bearish moves, the bearish swings would be a little bit longer, more energetic, more pronounced, and bullish moves would be less so. Obviously, that's not been the case in the last few weeks, but also remember that we haven't actually achieved anything. So this is kind of part of what you get when you get these sideways range-bound markets. Hedge warning status remains at level 1, a caution light. We still do have a number of cautionary conditions present, so we want to make sure that we are respecting that with the initiation of our trades. Just because mechanically we have symbols that are, in intermediate term market postures and market timing signals that are positive, doesn't mean we have no awareness of where we are in the chart. And across all those indices, we're right up against significant areas of resistance. So if you're initiating new positions, if you need more bullish delta in your portfolio, you need to consider a range of potentially defensive structures to be able to make that happen. Give yourself more bullish deltas, and yet at the same time, don't be just going a whole bunch of long delta right into the face of a wall and run 100 miles an hour into a concrete wall. And indeed, you see this reflected in our covered call strategy opinion. You do have permission to initiate new positions, but you're going to want to consider 1-to-1 ratio of in the money and out of the money strikes. Give yourself some buffer. Also 1-to-1 ratio of low beta and high beta positions. Be aware of which sectors seem to be gathering the most consistent strength, and then those players within those sectors. Consider legging into covered calls with conservative well out of the money put selling. And if the market does go back down to the lower part of the range, you have the decision of either rolling out or perhaps taking assignment at a discount of those shares and then converting that into the covered call strategy through what we call the wheel. Put selling, of course, very, very appropriate in this current environment, perhaps the most appropriate thing to do for most on your watch list. Selling puts below the market in a position size and scale that you're willing to own should the market turn back down to at least the lower edge of the range. In terms of option and income strategies, while premium is relatively low at this point, if indeed we are going to stay in a range, this might be, the easiest strategy at this time until new information comes into play. I would continue to take a look at option income strategies. In terms of those specific volatility and other type warnings, you see the volatility ratio warning has fired 2 sessions ago, so that would give us the heads up that we need to be watching for increasing volatility. The VIX futures are in a daily squeeze, so we'll continue to watch for that expansion in volatility as well. Distribution day count still just a bit high, just over our warning threshold of 5, though this has been coming down of late. We mentioned about the skew already, and it's now up over 130. Everything else is pretty much bullish. You notice the New York Stock Exchange new highs, new lows, up over 300 on the new highs yesterday. Positive sign. All 5 of the key intermarket risk aversion indicators still risk on, so no warning signs thereof yet. I will say that some of these look like they might be starting to roll over, but certainly just the appearance of rolling over is not a signal, and they're not even that close yet in the most part for a rollover, so I don't even want to mention that too much, but it's just kind of note. In terms of sentiment, we do have in the stock short term relatively high sentiment, and bonds also a bit high on the sentiment extreme. Also from an individual ETFs, the semis, SMH, also in a relatively extreme sentiment position. So we watch for potential reversal patterns. Just because they're extreme does not mean that they are ready to turn. Another sentiment indicator, our fear and greed index that we get from one of our products that we follow, is now in the upper quartile. Yesterday was also just barely there, and it's actually extended that streak into the extreme greed zone. So again, watch for reversal signs. It can stay in this extreme greed zone for prolonged periods of time. In terms of market sector specific, you see pretty much a sea of green, with the lone exception being retail. But also note that from retail standpoint, and I had something else from the morning reading here. Let me see if I can find it real quick. No, I'm not going to take the time. But retail's been certainly improving. So while this appears from the mechanical signals as down, neutral across the 3 time frames, there's been pretty significant retail heating up of late. So it's playing some catch up and maybe at a bottoming pattern. In terms of percent change yesterday, consumer staples, healthcare, utilities, look at that. The most conservative, defensive-oriented sectors were the leaders yesterday. So while the market did finish the day up, where did it finish up? It finished up with the defensive sectors, whereas the information technology, consumer discretionary, industrials, were relatively weak. And then you have energy and financials and materials rounding out the middle of the pack. So I think that's probably enough for today. We've gone just over 20 minutes, so let's go ahead and roll. And as always, continue to power through to those YouTube subscriptions. We hit 200 subscribers with yesterday's action. And I just continue to marvel, having started this project from, a flat start with, no established followers or anything like that. Just starting with social media not that long ago. We're already up to 200 subscribers on YouTube and well over 12,000 views in a relatively short period of time. And indeed, subscribing to the YouTube channel is going to be the best way to see when we actually publish content, because we're going to start being more variable in that time frame. I was looking over my schedule for starting next week as I kind of settle into my new Rocky Mountain home, and I do anticipate on several nights a week that I will likely be producing this YouTube market preview video in the evening before. So subscribers will know when that happens, and they'll get notice of that content. Also, when you're watching from the YouTube channel, of course, be sure to watch it in high def. Once you get that notice of content being published, give it a couple minutes, finish being processed and available to playback in high def, and that'll give you the sharpest resolution. Also, you can go to full screen and, of course, take this to a 1.5 speed playback. We're going to roll through the rest of this. If you see something, just hit pause, reverse, etc. Go to that hyperlink and get additional information. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the full disclosures can be found at this hyperlink at the bottom of the page. And in the meantime, we'll see you back here for tomorrow's market preview. Good trading to all.